Welcome to Life Planning 101, brought to you by Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more. All covered now on Life Planning 101.
We're here today on another episode of Black and White Market Chatter right here on Life Planning 101. Matt Ervin and Aaron Kennedy here with you today to hopefully give you a little calm amongst the storm, if you will. Aaron, talk to us a little bit about what's going on.
This is getting to be a really fun time. So what I mean by that is the market's moving, and it's moving a lot. And we're starting to get people to call and, just a little bit of worried. I don't think you can keep from it. If you turn on the TV, watch the news, read the news, there's horrible things going on, everywhere you look. So with all that negative publicity about everything, it's easy to get down and, kind of lose your way or lose that optimism. So kind of wanted to talk about how to keep that up, because
the important thing, I think, would be to say what's real and what's not.
Yeah.
How do we see through some of this and sift through some of this? I know you're going to get through some of this today, and I'm excited to hear about it. But where do you want to start?
Listen, so when we think about investing or you're buying into the market, one of the things that we lose sight of is that it's a market. It goes up and down. Being investing, that is not just a money printing machine that only goes up and only benefits. It goes both ways. And even if the market's going straight up, and the market feels good, there's still people on the other side of that trade that are losing while the market goes up.
Right.
So it's important to realize that markets go up and down. And there's nothing wrong with the market going down. There's some great positives to it. But usually we get in the way mentally, and we end up hurting ourselves.
Well, it's hard to think about that, though, right? Because the market's acted so different over the last several years, where it had points of this going straight up and you never felt the downside. And then when it hit a downside, it bounced right back. So this one's probably, I guess, more normal compared to historical nature than what we've seen over the last 3 or 4 or 5 years.
Yes. And, the objective of investing is buy low, sell high. I think everybody can repeat that. And I don't know when we learn it, whether it's in the second grade or what, but it sounds so easy. But why am I getting phone calls now about whether to get out of the market? Because it's going down. So
it's not comfortable.
Right. Do we really want to sell low and then wait till it gets higher and buy back? The exact opposite. That's that's really the recipe for disaster. So how do we wrap our mind around and make something positive out of something that hurts so bad and that's such a negative? So one thing I really wanted to talk about is our 80-80 rule. And our goal for the majority of clients is 80% of the downside and 80% of the upside. Horribly, horribly boring. It's not something you really brag about to your friends or your family or anything like that, but let me tell you how it works. The magic to this recipe is limiting the downside. And anytime you're limiting downside, you're giving something up. So in this, we're giving away the positive or the upside. So I want to do a quick exercise, and we're going to use 2-year returns and big numbers so we can see it in action. But if you have $1 million portfolio and the market loses half, you're down, you wake up in the morning and your account's worth $500,000, $500,000. In order to get all the way back to even, your portfolio has to make 100% or double. So in that instance, lose 50% one year, make 100% the next, we're flat. Now let's add our 80-80. If the market goes down 50 and we only capture 80% of that loss, we still lose 40%. 40% is not a fun number. It's
still uncomfortable.
People are going to be mad. They're going to be scared. I'm going to get some phone calls and people aren't going to be nice,
Right.
Even if I only lose 80% of what the market does. But same scenario, you wake up in the morning and your $1 million account's down to $600,000. The following year, the market doubles. Now, we don't get all of that. We only get about 80% of that. So instead of making 100%, we make 80%. But even then, 80% of 600,000, that's $48,000. So at the end of the day, our account value is 1,080,000 versus
So 600 plus 480,000, so we're still ahead 80,000 versus
still
being
ahead.
flat.
Right.
Wow.
So why did that work? And it was just that we were more cognizant of the downside, and we tried to protect downturns. And when you do that, you're going to give up the upside. But as long as you get the majority of it, and you stay in the game, and you don't try to change your goals. Your goals need to always be, I'm risk conscious. I'm always looking at risk. Not to the point that you're fearful and doing things that are,
Or greedy.
Greedy.
I think that's important to notate, because jumping all in, and really it comes to making that emotional reaction to a high or low in the market.
Yes.
Either one is harmful.
I think I was talking to Chance, which is someone here in our office, and we were talking about risk levels. And I said, I have a lot different feeling if people are changing their risk levels at a time in the market when things are changing. For instance, if the market goes down 50% and someone tells me they want to increase their risk. Okay, now this is somebody that kind of understands it and has put a lot of thought into this. And I'm much more willing to have that conversation than if the market drops 50% and they want to decrease the risk. Then I know it's just emotions, and they're being a typical human,
Right.
and we need to have a conversation about how all this works.
Yeah. Let's take a quick break right here on Black and White Market Chatter Life Planning 101. We'll be right back with you. And we're back on continuing part 2 of Black and White Market Chatter on Life Planning 101. We were just covering emotions and getting in or out at inopportune times in the market, and really, it's getting on or off that volatility roller coaster at the wrong time. Strategic entry and exit's okay, but either one's you'll get hurt getting on or off at the wrong time.
So, back to it. I am excited about what's going on. This doesn't happen too often in history where the market really goes down, and I think we're going to have that kind of volatility in some parts of the market, and I'm excited because I'm going to be able to take advantage of it. What would you do if you could go back and buy Amazon at 50% of what it is today? What if you could go buy Amazon at 2002 prices?
Sure.
Would you do it? What about Tesla in 2012 or Walmart in 1988?
Right.
There's great companies out there. And if we had the opportunity to buy them at fantastic prices, you need to be backing the truck up. But it's very hard if you look down in your portfolio and only half of it's there. That's scary. So, number one thing you do, you need to have some safety built in or some dry powder. Doesn't have to be a lot, but we're just talking about psychologically, what do you need to do? You need to have some dry powder. You need to get excited about buying great deals. I'm working on this right now. Of me personally, I'm picking out companies that I would love to buy. Now I'm going to have a list of them. I'm going to see those prices and what they're doing. And I hope they go down.
Right. Right.
So there's some that I've been looking at for 10 years, and I can't stomach to pay twice what I think something's worth. But if it goes the other way, I'm licking my chops.
Well, but to your point, there are many pockets in the market that are still overpriced.
Yes.
You don't feel it. You don't see it on the news. It doesn't seem like it, but it's very true. And I think, we ran a podcast just a week ago about remembering what the money's for.
Yes.
And that helps you be more logical to say, this money is to help me in the future, right? This is not your income bucket. This is your future money, right? We're taking advantage of that for our down the road.
Right. That's a great point. Think about all the changes in our life right now. Think about all the technology out there. And yes, a lot of those companies are way overpriced, but this is a market of companies. So we're getting to the point where we can dig through and find companies that are dirt cheap. Got to remember the market, the S&P 500, 25% of it is, Amazon, Google, Facebook. It's being driven by these huge companies, and it's masking a lot of the downturns. But there's companies out there that produce robots that do surgeries on us, and it cuts down on surgeon error. It helps with recovery times. A robot.
Right.
So wouldn't that be cool to be able to pick up that company if it's growing at 30-40% a year, but you can get it at a price that's reasonable, that you can make money?
Right.
What about, we already talked about Amazon, but what about if there's a company out there that alters our DNA, and can help with heart problems or diabetes, and they're at the cusp of being able to fix those things? Would you want to buy into a company like that if it got cheap enough? Yeah. What about, Microsoft? They're one of the largest companies that save our data in the cloud. What if that got low enough? Are we still going to be using the cloud 5 years from now?
It may take a different version, but there'll be something there for that need.
Yes.
I think that's your point. We need to look forward and say, what can we pick up today while it's cheap? And what can we have our dry powder, what can we take advantage of? That way, maybe we can pick up the Teslas and the Walmarts and the, all the things that we wish we would have done 15, 20 years ago. 15, 20 years from now, we can be having a different conversation.
That's right. So how do you wrap your mind around that? How can you start to think down is good? Because down is good.
Right.
Staying down is not. Don't get me wrong there.
It's not comfortable, right?
We're just talking about volatility in the market. And how I manage money, I have to look at risk differently than what I believe risk is. That sounds weird, right?
Say, you might have to expand a little bit on that. Help me understand that better.
So if I'm managing my own money, risk to me is destruction of capital. If I buy a company and tomorrow it's bankrupt and does not exist,
that's a risk.
That's risk.
Right.
My dollar disappeared.
Permanently. Right.
If I wake up in the morning and the market's down 2.5%, that's the market doing its thing. Mm-hmm. That's normal. That's average. That really shouldn't scare me. And it doesn't. But when we're working with clients' accounts, I go the other way. I say volatility is risk, because if I'm owning every stock out there in the market, I'm very, very diversified. The one thing that's going to hurt me is making a bad decision.
Right.
And what makes us make bad decisions is price going up and down.
Okay. Our emotion, our reaction to that price.
Reaction to volatility in the market. So, when we're talking about the 80-80 rule or anything like that, or our risk measures, what we're trying to do is smooth out the volatility, because our goal is to keep you invested over time. We want to be doubling whatever your risk level is. If you should be 70% in the market, we should be doubling your money over 10 years. If you're a typical person and you invest on your emotion, that's where most people make 2% a year, and it takes 35 years to double.
That sounds like a lot of fun.
So
hey,
I'd want to do it in 10 or 7, wherever your risk level is.
Let's take another quick break while we're here, right here on Black and White Market Chatter Life Planning 101. We'll be right back with you. And we're back here with the final segment of Black and White Market Chatter on Life Planning 101, trying to find the opportunity in a volatile market and really trying to be comfortable with making some long-term purchasing decisions and really trying to eliminate our short-term emotional reactions to volatility.
Yes. So let's put some real thought into how we think this plays out. I have no crystal ball, but we're going to throw out some ideas of what could happen.
Like you're talking specific to the market?
Specific to the market, okay. Time frames and everything else. And let's try to get a grasp of whether our ideas are rational or not.
Okay.
Right now, the Fed is raising interest rates And raising interest rates is going to slow down our economy. And the belief is if they slow down the economy enough, inflation will go away. So let's throw out the idea that the Fed's never got it right. They're 100% track record of taking things one way.
Doing the wrong thing.
Too
right?
far. Yes. So let's say July of this year, the Fed has raised interest rates another 1.5%. The market finally says no, and it drops by 50%. Okay, July, we look at the market's down 50%. Fed comes back and says, uh-oh, we made a mistake.
Do they ever actually admit it? I just want to know that.
Yeah, they did in 2018, the taper tantrum.
Okay, all right.
But let's say they come out and say,
Just
hey,
kidding.
we got a little bit over our skis. We're going to have to stop this, and we need to pay more attention to the economy. Market's down 50%. It takes us 2 years to get back to even. So have a horrible 2022. Market drops 50%. By 2024, we're back to where we were at the beginning of 2022. You know, if you think about it, that's pretty close to what normally happens. We have a market correction. It takes us 2 years, maybe 3 years to get back to where we were. Really bad times. You know, we're thinking somewhere between 2 and 7 years. So how upset would you be if in 2 years you made 100%? The end of 2022, we're down 50%. By 2024, we're back to even, so we had doubled the account size within 2 years.
I think that's pretty fine.
Yeah, and the count is at zero. But what I mean by zero is zero growth.
Right, flat.
Down, up. But if we've done the things that we should, you know, we've had dry powder. You know, we're not 100% all in the market. You know, we've made good purchases. We got excited when the market went down. We took advantage of it. Within 2 years, even if the market's back to being even, we should have done well. And over a 3-year time frame. 3 years is not that long. And the important thing to remember, if we don't do the right thing, that 3 years can alter our lives for the remainder part of our life. Permanently. Because if the market goes down 50 and you decide to get out, the market goes up 100% in 2 years, gets back to normal, what happens to the market after that? You know, usually it's kind of average,
Sure.
which is 10%. Which is if you're 100% in the market, if you get back in after that, it's still going to take you 7 years. Right? So what did we do to your time frame or your life? It takes us a long time to fix things.
Well, and so, you know, I've had a couple reviews for our clients where we'll walk through if you would have reacted emotionally in March of 2020. We know that was a pretty significant, dramatic pullback in the market that was pretty quickly followed up by a sharp recovery. You know, I think we can all remember that. But if you would have reacted emotionally, you would have wiped out about 3 years worth of gains. And not only would you have, if you would have wiped out the 3 previous years, you would have missed out on the double you got. And it's not the same for every person, of course, but the point being, making that emotional reaction is going to permanently, and will, because we've seen it, could permanently hurt you. And that's our job, right? At the end of the day, our job is to help you make logical decisions.
Right. And it can be done. We're planning for this scenario right now that the market is going to act funny.
Right.
You know, we've been planning for it. And go back and listen to our podcast, even
fall, last summer even.
We're talking, hey, this is coming down the pipe. This is the things that we need to be doing. These are the steps that we've been taking to take advantage of this. And nobody has a crystal ball. And, you know, there's going to be some people out there that say, hey, sell and go to cash and I'll just wait. And is that the right decision? My answer is no. Go back and look at anybody in history who made the perfect market call. How often have they done that?
If they've done it, it's only been one time.
It's only been one time.
It's not repeatable.
And you can go out in the market any day and you can find somebody that's bearish or meaning that they believe the market's going down. And most of the time they have great reasons behind it. But the waiting game things have been overpriced since about 2013. So if you were just going on price, waiting for things to get back to normal,
We'll be waiting.
whoa! So going to cash is usually not a good idea because your timing's not perfect. You need to get as much of it as you can. But we got to have these little tricks in our mind of why down is good and how we're going to take advantage of it.
Helps us stay disciplined to reach our
Stay
goals.
disciplined.
So at the end of the day, we want to help get you to retirement or keep you retired, right? But you have to participate.
You have to participate.
If you don't participate, you're going to miss out, and that's the thing. So, Aaron, we're getting close to time. Do you have any last thoughts you want to throw in?
Just real quick one. What I've been talking about is mostly greed. If you think about it, keep some dry powder when the market falls apart. Jump all over it. Greed. But there's other reasons to get excited about market going down, and we don't have a lot to talk about it. But if you're doing Roth conversions, yes, you want the market to go down. I can cut your taxes in half. Roth conversions, if we need to rebalance the portfolio and you got some monster gains in there, market coming down is beneficial, especially if it's temporary.
Or even some tax loss harvesting, just to know that when we do make some money, we have some losses to maybe get out of some taxes. So.
Yes. Anyways, guys, I'm excited about what's going on because times like now don't happen very often, and we're going to take advantage of it.
So right here, we're going to wrap up our last segment of Black and White Market Chatter on Life Planning 101. I hope you all have a wonderful day. Please call us if you need anything.
God bless everybody.
Thank you.
Thank you for joining us for Life Planning 101, brought to you by Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Don't forget to learn how our sister company can assist you with all of your tax, bookkeeping, and consulting needs. You can find out more at briscoeandassociates.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton & Associates Incorporated, a registered investment advisor, member FINRA SIPC. Investment advisory services offered through Smart Money Group LLC. Kennedy Financial Services and Smart Money Group LLC are separate entities and are not owned or controlled by Calton & Associates Incorporated.